An orange fire tears across the Manama skyline. It's Bahrain's only oil refinery, a brand new $7 billion facility, now just a column of black smoke. This wasn't an accident. It was the decapitation of a nation's energy supply. But the true weapon wasn't the drone. It was the two words the company sent to all its customers: force majeure, a declaration that all promises are now broken. To understand this new battlefield, we will trace the causal chain from a single strike to a global economic shock and identify the positions required to shield your capital. Because what the markets failed to price in that morning was a single, terrifying fact. The fire in Bahrain. It wasn't the beginning. It was a signal that the first phase of the war was already complete. That first phase was a systematic paralysis of the world's energy artery, executed with chilling precision. To understand the fire in Bahrain, you have to first see the system that was already bleeding out. Let's run the timeline. March 2nd, Saudi Arabia. The giant Ras Tanura refinery, 550,000 barrels per day, goes dark. Aramco calls it a precaution after a drone strike. It was the first piece taken off the board. 2 days later, March 4th, Qatar, the LNG titan Qatar Energy, declares force majeure. Its Ras Laffan facility is hit. Just like that, a facility responsible for 20% of the world's LNG supply is choked off. The contracts are broken. 3 days after that, March 7th, Kuwait. Kuwait Petroleum is forced to slash its output, not from damage but from direct threats to its tankers in the Strait of Hormuz. The supply lines themselves were now the target. Each of these was a body blow, but the system was still standing. The Bapco fire. It wasn't the first domino. It was the last one. The one that made the collapse irreversible. But the fire you saw on the news wasn't just burning oil. It was erasing capital from the global ledger at a speed that no algorithm could track. And while the markets were still debating the price of a barrel, the real cost was already being calculated in the trillions. We're about to show you exactly how that money vanished. The oil alarm bell rang. This time not a polite chime, but a fire siren running through every trading floor on the planet. Within days, the story stopped being about tankers in the Gulf and became about a financial firestorm ripping through trillions in paper claims stacked on top of every barrel. Futures, options, credit lines, the collateral beneath pension funds. In less than 10 days, Brent crude traced a vertical line to $119 a barrel, blowing through hedging assumptions, triggering margin calls, and forcing levered players to dump whatever they could to raise cash. As oil spiked, models penciled in higher input costs, squeezed margins, rising recession odds. From Tokyo to Frankfurt to New York, the same pattern rolled across the screens, major benchmarks sliding in lockstep as order books thinned, while one headline about $119 Brent looped. And phones lit up on risk desks. A pension fund manager watched the green on his screen turn into a column of red over a single coffee break. Then took a call from a client asking why 20 years of contributions had shrunk in one session. The final tally was brutal. Since February 28th, an estimated $6 trillion has been wiped from global equity values. $6 trillion. Not a government budget line, but pension systems, index funds in retirement plans, tech bellwethers like Samsung watching their stock price sink as investors priced in supply chains freezing from chips and phones to cars. If you have a 401k or ISA, own a house, or buy fuel and groceries, a slice of that $6 trillion was yours. When the closing bells finally stopped and the first postmortems hit analyst desks, one thing stood out. The move had been too fast,
too synchronized, with losses clustered in crowded trades.
That's when the question stopped being academic. Was this just a spooked market, all hitting the same exit? Or was it architecture, a controlled detonation in the financial system, using panic itself as the weapon? This was architecture, and the architect wasn't hiding in the shadows. They signed their work in plain sight. The architect of this ruin was Iran. By that evening, as refinery fires looped on every channel, Gulf foreign ministries held the same message from Tehran, half stamped confidential, half read into microphones. The terms were simple: stand with the United States and watch your ports and pipelines burn, or publicly step back from the war and your lifelines stay intact. Now shift to Berlin. A cabinet office, fluorescent lights humming. On one line, the finance minister reads from a spreadsheet. At $200 oil, the energy budget blows apart and steel plants plan to shut furnaces for the winter. On the other line, Washington on speaker demands they hold the line, promising unity will be remembered. Tehran's design was simple. Squeeze crude toward $200, drive up fuel bills, and let that cascade into layoffs and falling poll numbers until Western leaders had to choose between the war abroad and their jobs at home. And then they named the price out loud. On state television, an Iranian military spokesperson, a figure linked to the IRGC, looked directly into the camera and delivered the official terms. If you can tolerate oil prices above $200 per barrel, he said, continue this game. Iran had just declared war on the global economy itself, and in that moment, all eyes turned west to an emergency G7 meeting in a guarded conference room. The world's most powerful economies were about to announce their answer. A counter-move with every balance sheet now on the front line. And the response came. Swiftly. On the morning of March 9th, the G7 finance ministers, in coordination with the International Energy Agency, stood unified. The message was meant to be decisive, a signal of overwhelming force to calm the markets. They were unlocking what they framed as the ultimate financial weapon, their Strategic Petroleum Reserves. The headline number was massive. A coordinated release of up to 400 million barrels of oil from those reserves. For a brief moment, it sounded like a firewall, a fortress of barrels the world's largest economies could throw at the blaze. But on the desks, the hope didn't last. Global oil demand, on the IEA's own figures, is roughly 105 million barrels per day. The Strait of Hormuz carries about 21 million barrels of that every day, a fifth of the system, and those flows had just been cut. The G7 was offering 400 million barrels into a market that burns 105 million barrels a day to paper over a 21 million barrel hole. So you write the only equation that matters. 400,000, 105,000, 4, not 4 weeks. 4 days. 4 days. For anyone who's ever run an energy book or a logistics chain, that's not strategic depth. That's one bad long weekend. From that moment, the official solution wasn't a backstop. It was a timestamp. A public admission that the system had, at best, 4 days of artificial life support to hide a 21 million barrel per day loss through the Strait of Hormuz. That is the point where the announcement turned into a doomsday clock. If you're actually running capital or real operations through a scenario like this, I want your read as a professional. What would worry you more at that moment? The physical 21 million barrel cut, or the realization that the institutions at the top seem to think 400 million barrels was an adequate fix? Put it in the comments. Treat it like a live risk debrief, not small talk. The G7 plan didn't stop the crisis. It simply put a terrifyingly precise expiry date on the illusion of control.
The clock was now officially ticking, and they had just shown the entire world that when it hits zero, there is no one left to call.
Before we map the winners of this conflict, you need to feel its speed. Because in the first 12 hours after the G7's plan evaporated, capitals skipped a joint response and went straight to emergency switches alone. It was every nation for itself. In Tokyo, the break from order was bureaucratic. Before day one even closed, a terse bulletin authorized emergency use of national petroleum reserves, a tool meant for once-in-a-generation shocks, pulled without allied consultation. At roughly the same hour in Seoul, cars idled outside gas stations as people filled tanks and containers, horns blaring, while a shaken energy minister begged them on TV to stop hoarding. On the split screen of those broadcasts, a window showed another scene starting. Nameplates lighting up around the horseshoe of the UN Security Council. In that chamber, the United States, the architect of the strikes, sat exposed as delegate after delegate. Not just Russia and China, but neutral Switzerland and allied states condemned them as reckless. The alliance was a ghost at the table. No resolutions, no promises of ships, fuel, shared reserves. A signal Washington would have to carry this war's costs and supply alone. Moral cover peeled away when Pope Francis called for de-escalation, framing it as a catastrophic miscalculation that empowered Iran's strategy. When leaks from inside the US intelligence community surfaced, assessments questioning whether the original war objectives were achievable at all, markets priced in failure, and capital edged away from anything tied to a US-led order. While screens stayed on gas lines and UN speeches, Tehran's broadcast cut to the image of a cleric. A caption confirmed what insiders whispered. Iran had named a new supreme leader, and state TV showed Revolutionary Guard commanders pledging allegiance. As everyone else burned fuel and political capital to hold their lines, the endgame was being condensed into the will of one man. A man with a personal score to settle, a son with a father to avenge. On day 10 of the war, as the Bapco refinery fire still choked the sky over Bahrain and the world's emergency reserves bled out, the final, most dangerous piece of the puzzle fell into place. In Tehran, Iran's assembly of experts named a new supreme leader, Mujtaba Khamenei. He wasn't just any cleric. He was the son of the Ayatollah, the son of the man assassinated by the United States at the very start of this war. He inherited a nation with its military machine already at full throttle and a world economy on its knees. There were no signals of peace, no calls for de-escalation. He doubled down. From his office, he watched the global chaos he inherited. He didn't see it with alarm, but with the grim satisfaction of a plan unfolding. That fire in Bahrain wasn't just a fire. It was his father's funeral pyre, and the world would pay for the fuel. The goal remained the same, and the world was now on his clock. So you have three images. The face of the new leader, the refinery still burning, and the oil price ticker closing the day at $119.50. The distance between that number and $200 is the distance between where this war is today and where Iran intends to take it. But this story of total systemic collapse is only the surface story. It's the narrative for the public, for the panicked. For those of us managing capital, there is a real story unfolding underneath. A story not of destruction, but of redirection. And that is where we are going now. So, the world ends. Right? Wrong. That is the surface narrative, built for headlines. For capital, the real story, the actionable intelligence, is that this is not a uniform catastrophe. It is an asymmetric war, wired into the energy system. For a manufacturer in Germany who sees power and gas costs jump until margins disappear, this is a death sentence. For a shale operator in the Permian Basin facing the same Gulf shock, it is the beginning of a golden age, because the disruption in Hormuz and Ras Tanura that detonates European input costs is the same disruption that lifts the price of every barrel they can pull out of the ground. This divergence isn't accidental, it is structural. The United States built out a shale network while Europe and Asia locked into import infrastructure tied to choke points like the Strait of Hormuz, Qatar LNG, and Saudi's Ras Tanura. So when Iran turns those choke points into an economic weapon, shutting in Qatar LNG and putting Ras Tanura at risk, Europe and Asia face physical shortage and a direct threat to their industrial base. The United States is the world's largest oil producer. Domestic supply doesn't make the US immune, but it does mean the shock shows up mainly as price volatility and inflation, not fuel rationing and factory shutdowns. Wood Mackenzie, in its latest outlook, underscores that point. Incremental US shale output is one of the few levers capable of easing that tightness. It cushions the domestic market, then, as barrels move onto the water, lets US producers step into the gap and capture market share at crisis-level prices. In her latest remarks, the US Energy Secretary confirmed there are zero plans to strike Iran's energy infrastructure. That is not a moral statement, it is strategic. Washington is managing this as the world's indispensable energy banker, not pushing for a clean military knockout. This is not a global collapse. It is a generational wealth transfer from energy import-dependent Europe and Asia to North American producers and infrastructure. For capital, the blame game is academic. Only positioning generates returns. In the final part of this briefing, we move from analysis to execution. Specific, concrete steps to restructure your portfolio for this new reality. Your playbook is built on one core reality: the permanent fragmentation of global energy markets. The acute shock, the price spike, and the scramble for spot cargoes is fading from the tape. What remains is a new baseline. The old rules of globalized efficiency no longer apply. Visualize two columns. On the left, the old world, lowest cost supply lines, just-in-time inventories, and single points of failure. On the right, the new world, regional blocks, redundant capacity near home, and energy security priced as highly as efficiency. The map you and I now invest against. The Atlas Institute's post-crisis review names the key second-order effects: diverted supply chains, locked-in rerouting costs, and a geopolitical risk premium permanently baked into energy prices. Those three forces add transport, redundancy, and political insurance to every barrel and kilowatt, pushing not just energy costs, but the inflation floor higher for years. These dynamics create clear winners and losers over the next decade. Chatham House, in its March 2026 paper, Energy Insecurity and Growth, warns that import-dependent economies face long-term vulnerability as persistent high energy prices widen trade deficits, weaken currencies, and squeeze margins. The winners are diversified producers in stable regions with domestic resources and existing infrastructure. On that list, North America is still the prime staging ground. Fragmentation pushes governments and corporates into friend-shoring and regional supply deals, paying more to buy from politically acceptable partners. Those rerouted flows and premiums lock in higher, more volatile input costs, which sap growth in net importers and shift long-run return leadership toward net producers, hard assets, and the pipes and wires that move energy. Energy exposure here means the sleeve of your portfolio already tied to energy. And the transition, positions in producers, utilities, commodity-linked equities, and related funds, not your whole book. Within that sleeve, target a 15-25% shift toward the structural winners. That band is big enough to matter over a 5 to 10 year regime shift, but small enough to cut back if the thesis is early or overdone, and you phase it in over the next few quarters instead of in one trade. First, US and UK domestic producers, listed exploration and production companies, integrated majors with North American or North Sea assets, or broad energy ETFs if you prefer diversification. Second, critical minerals, diversified miners and targeted funds with exposure to lithium, copper, nickel, and related metals. Third, the infrastructure that makes this system work, pipeline and storage operators, regulated utilities upgrading the grid, LNG and export capacity, accessed through listed infrastructure and utility funds. At the same time, hedge the beta that still assumes the old model snaps back. Review your exposure to broad Asia-focused equity indices, export-driven manufacturers, and multinationals with cost bases anchored in East Asian supply chains. Then underweight those holdings or pair them against overweights in North American energy and infrastructure. Your checklist is straightforward. Overweight domestic producers, critical minerals, and energy infrastructure inside your existing real asset sleeve. Underweight the most energy fragile importers and Asia supply chain beta, and pace the shift over the next few quarters while pricing resets. You now have a 5 to 10 year causal chain and clear levers to pull. This is how you move from fear to strategy. If this analysis was valuable, subscribe for more insights on navigating the new rules of this chaotic world.